Today, the real story on rates. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by Steve from Canstar. Hi, Steve.
Hi, Martin.
How are you doing?
I'm terrific, thank you.
Interesting week we've just had, and I thought it'd be good just to pick your brains on a couple of things. Firstly, the Reserve Bank basically said, don't hold your breath. Rates will rise, but not for some time yet, which seems to be very different to where the market is. But if you look at some of the banks, they're still putting their rates up.
Yeah, variable rates are going up very, very quickly, and we saw it again in January. So the banks have obviously their funding has already been impacted, and the markets are saying rates are going up. And the market indicator, which is sort of a forward look at interest rates, is saying 1% by the end of 2022, 1% increase. Now, I don't believe that, and it's not always right. And certainly the Reserve Bank governor tipped a whole lot of cold water on that one. He said, look, the US is also, market indicator also in the US is saying 1% up, and they have 7% inflation, nowhere near that. So, yeah, I don't believe that for a minute, but it's quite an irony.
Yeah, and of course the UK also put rates up again, and they're forecasting a very high level of inflation next year and higher interest rates as well. So the whole question of cost of living and what it's going to do is becoming an issue beyond Australia. And to me, the interesting question is, to what extent can Australia insulate themselves from those international pressures? Because it seems to me, if I look at the results from Westpac that came out this week, their margin compression is quite severe, which means they're going to be looking for every opportunity to put rates up. And of course, they're going to find it harder and harder to be able to source cheap funding.
Yeah, that's right. I mean, Westpac has already said that they believe August will be the start of it, and that over 2 years will be up by 1.65%. So it's already happening in their eyes, and they're seeing it in their funding costs. So it is squeezing them, and there is no question in my mind that we'll see more increases to fixed rates in this period, because they have to fund those through the wholesale markets, and the wholesale markets have already put rates up, and you see it in the bond price. It's gone up.
Absolutely. So that's going to wash through one way or the other, which is why I think the Reserve Bank is being quite coy. Maybe what they're trying to do is to sort of slowly adjust to the different positions. But Phil Lowe was very clear on, the markets may not be actually reading it right, so we'll see where that goes. But he also made another interesting statement, and that is people need to have buffers because rates may well go up. And I thought, as a piece of financial advice from the the head of the Reserve Bank, that was quite interesting.
It was. I've never heard him say that. He was very clear. In fact, I got off the phone and spoke to a couple of people in the office, and I said, I think he was listening to the conversation I had an hour earlier. I think he's borrowed it straight from me, because I've been banging on about building up buffers during this period for a long time, and Lowe's come out and said, build a buffer. He said, I'm not going to tell you when this is all going to happen, but build a buffer. It's a no-brainer. You've got to do it. You know that your rate will be higher in a year's time or a year and a half's time at least. Bring it, if you can afford it, bring forward that rate increase. And what I mean by that is make the repayments that you would have to make with the increase, make them now, because if you make them now, you get ahead on your loan and you're knocking interest off the loan. When the time comes that the rate increase hits you, it's all going towards interest, not knocking your loan down. So it's a great time to do it. You really must do it when rates are low, because it's more affordable now than it will be when rates have gone up 1.65%.
And it was interesting that he keeps quoting, and other people do too, how many people are ahead on their mortgage repayments, months and months and months ahead, right? And of course, that may be true at an average level, but we also know that there are some people who are not ahead and only just making it at the moment. So unfortunately for those, the chances of building up buffers and being ahead with their mortgages is pretty much zero.
Yeah, that's right. I mean, I always have to preface it, if you can afford it, do this. Because people who have bought for the first time, in particular, first home buyers, who've bought in the last 12 months on this supercharged market, paid high prices, had big loans, and the younger people, so their income might not be as high as the average, they will struggle with that. And they're the ones that are going to be hit hardest with this, and they're also the ones that have lower equity in their property. So it's a bit of a double whammy for them. Unfortunately, interest rates go up and prices have gone up and will continue to go up for a while. So, you know, it's a real double whammy. It's a real hit on those people and affects what they can afford.
Well, I did an interview on Radio National earlier in the week, and I highlighted specifically three groups. The first-time buyers who bought relatively recently, the property investors in the apartment market who's still not getting the rental returns, right? And then some older people who are moving into retirement, or in some cases have actually had to move into retirement because their jobs disappeared, but they've still got a mortgage. Those are the three groups that, to my mind, are the ones most at risk.
Yeah, they are. It's often forgotten that there is a group there that still have a substantial enough mortgage when they retire, and all of that retirement savings or superannuation goes to knocking off the rest of that mortgage, or a big chunk of it goes to knocking off the mortgage. So they'll be on the pension and be hit by, you know, I guess a real cost of living squeeze. So they will do it really tough. Investors, well, they're in the fortunate position of having built up equity in the house they live in and maybe in other investment properties, so they've got more equity at least. But you're right, those in inner city areas in Sydney and Melbourne, where there's a shortage of renters, have really been hit with a squeeze on their rental income. So, yep, they're the three groups.
And interestingly, one of the things I've also got from my surveys is that some of the banks are now coming to have a difficult conversation with these particular groups, saying, look, your financial footprint has changed for these various reasons. It's unlikely that you're going to be able to recover from this, so you should seriously consider selling while you can. And of course, the expectation is that maybe the markets will ease back. So there seems to be a bit of a pressure, informal pressure, coming from some of the banks.
Yeah, the banks, they're loath to sell people up. It's a bad look, and you lose a customer, and it hurts people personally. So they are loath to do it, but they'll do it if they have to. And they talk to people when they still have equity and say, look, this is the time to get out, because at least you'll have some cash. If it goes on with deferrals of repayments or missed repayments, then you're eating into the equity and you'll have less left when you come to sell. And you can't just bank on house prices continuing to go up to fix that problem for you, because they might not, or yours specifically might not go up, or the property might deteriorate because you can't afford to do necessary maintenance. All those things come to play, and the banks know that. If you have lots of equity in the property and can't afford your repayments for loss of job or illness or whatever it causes, it's your problem. If you have low equity as well as the income problem, then your problem also becomes the bank's problem. And that's where, in particular, they'll start putting pressure on and saying, look, now might be the time, because we can see, and you can see, that you're going backwards, and there's no light on the horizon that's saying it will be okay.
Absolutely. And it's worth reflecting on that in the context of people are now saying, well, look, you know, some of those longer-term fixed mortgage rates will be above 4% before you know it. Some of those are already up more than 1.5% from the lowest that were available. You know, those movements are big. And when the interest rate is so low to start with, those movements up have a huge financial impact on people.
Oh, they do. And people who have fixed as well, say you're fixed in 2021, 3 years on, when you come off fixed, it'll be 2024. And chances are you'll be paying 2.5% more than you have been. And that comes as one heck of a shock. The numbers I crunched the other day, a 1.65% increase, I use that because Westpac are predicting that, adds $471 to the monthly repayment on a $500,000 loan. Now, that's a big hit. And, typically rate increases come in clusters, and within 18 months, 2 years of the first rate increase, you'll see, 6, 8 more. So you'll be up for 1.5%, 2% more on your loan, and the banks won't be absorbing it. There's no room in their funding to actually absorb the cost. So you'll be up for a massive number when you come off that 2% fixed rate that you took in mid 2020 to mid 2021.
Yeah, it is very interesting. And of course, NAB, CBA and Westpac have all put their fixed rates up. They've done a little bit of twiddling on the variable rate because they're basically outsourcing the risk moved back to those borrowers. ANZ has not yet done much this year. And I wonder whether they are about to come on board too, because of course they're behind the 8 ball, but they also have got less momentum in their mortgage book.
Yes, they have. They seem to be past the worst of it. I've got comparative numbers in here. Yeah, they haven't moved their 1 year rate or their 2 year fixed rate as much as the other banks over the last 6 months odd. And their lowest variable low is 2.19, so it's the lowest of the 4, equal lowest with Westpac. So they're like the other banks. I guess they're encouraging people into variable, but their 1 and 2 year rates are lower. So there's a little bit of Westpac's low on their 2 year as well, or 1 and 2 years, both of them. But you'd have to expect them to be moving that rate up. They're not immune from this, and they'll be squeezed on their margin as well. I think they're desperately trying to claw back the market share they've lost. And that says, well, look, let's do everything we can for a while and push as much onto variable as we possibly can. But I think we'll see a bigger disincentive to fixing with them in the next week or so. I can't imagine they'll stay there on that rate. It's NAB and CommBank have both bumped up, and I can't see why Westpac and ANZ in the same funding market can absorb it.
Absolutely. And it's interesting, if you look at the latest APRA statistics, the growth rate over the last month for 3 of the 4 majors was very strong, including Macquarie. ANZ right over the other side, right? So they're just not getting the traction in the market, which suggests that they're probably trying to hold the line with their rates to try and gain share. But in the process, of course, their margins will get squeezed further. So it's very tricky for them.
Yeah, they've had a real supply side problem in that they haven't been able to process loans fast enough. Now, that's really damaging to people. If they miss settlements, they can actually lose their deposit. Now, that's been changed. There's action being taken on that to help people out of that problem. But it's still devastating if you lose a property you want to buy because finance hasn't been approved. And late settlement will come with cost as well. So they have to compensate, and they've taken a long time to fix their supply problem. So I guess they feel, look, we've got to compensate and try to claw back that loss of market share. And the reason market share falls a lot faster today than it used to is that brokers are responsible for such a big proportion of loans in the markets. It's over half, something like 60% now. And the word gets around very quickly in the broker community, and the aggregators keep them well informed and say, look, ANZ's struggling to get approvals on time. So put your loan somewhere where approvals come through.
Yeah, the brokers have their finger on the pulse because, of course, it's in their interest to know where they can get the loans approved quickly and effectively. And therefore, if your systems are not up to pace, it does spread quickly, doesn't it?
It does. Everything happens faster.
Yeah.
And, the internet's made the whole world faster, and brokers have made the whole of the lending market faster.
Last question today, Steve. The latest ABS on new lending, which came out just a couple of days ago, was very strong. It's actually quite a lot stronger than I expected. You wonder how much longer this can go on at that strength.
Yeah, look, it was 4%, 4.4% or something up on the prior month, and that's seasonally adjusted. So it was probably, I didn't even look at the raw data, but seasonally adjusted 4% up. Now that's a massive increase. If that goes on for 12 months and you compound it, you've really got, a market that's grown over 50%. It's boom times. And can it continue? Well, I think we're going to see some supply issues, but that will bid price up. So, so in terms of dollar volume of lending, well, that's pretty active. The average loan went up something like $80,000 or something over 2021. So it's really right up. So will it continue? I think it is going to continue for a while. I think the first half of this year is going to look a lot like the market in 2021, which is really disturbing because I think you've got to take a long-term view of Australia and social equity and say we are pricing too many people out of the property market. And I think that's going to hurt long term. People are going to have to rely upon aged parents leaving this world in a lot of cases to get into property, much as they have in parts of Europe, I suppose, for a long time. But it's a problem if it continues for anything beyond a short period of time. Now, the Reserve Bank, of course, said, look, it's not our baby. It's not our fault. There are all sorts of issues behind price increases, and there are. But I don't know who's going to fix it, and it's a tricky solution.
Well, talking about fixing it, right? The RBA has said house price is not our problem. APRA says house price is not a problem, and this week Scott Morrison came out and said we can't control house prices. So actually, that means that nobody's taking any responsibility for what's gone on, and it's just worth reflecting that the reason house prices are going up so high is because of the free lending that we've got. The loan size is bigger. So until credit is actually more controlled, you've got to expect house prices to continue to go higher, as you say, despite the social equity issues that are created.
The last 12 months has seen just a boom market in investment lending. It's up, December was up 74% on December 2021, December 2020. So it's been a massive boom in investor lending. And investors compete directly with first home buyers because an investor buys a property, they don't sell another one. A first home buyer buys a property, they don't sell another one. Upgraders buy and sell. But so they're competing directly for the stock of property that's on the market. So when investment lending is up 74% on a year earlier, that is putting the squeeze on first home buyers. Now, if you're going to, and it's probably the lever that can be pulled by government is the incentive to invest in property. You gear property, so you're investing $100 for every $20 you have, and you are entitled currently to claim the loss on the property, which is mainly interest cost, against your other income, negative gearing. Now, the last election, the opposition took negative gearing and dividend imputation to the electorate, and it was seen very negatively. But I think something has to be done on the negative gearing front, and probably also on the capital gains tax discount, because you're paying half the tax on a capital gain that you're paying on your marginal dollar, your top dollar earned through your labour. I think those two levers will eventually have to be pulled to actually slow up the growth of investment lending and give first home buyers a go. However, it's electorally very hard.
Well, I suspect that somewhere along the lines we'll get the line from the current incumbent government saying house prices will always be higher under us. It feels to me the way it's going to go, because they have definitely aligned themselves towards supporting the housing sector and getting more people to come in, 300,000 over the last 3 years, they said during the week. But of course, it's not doing anything to take the long-term pain out of the market, right? And the trouble is, Steve, that the more you let this run, the more over long-term trend prices go, and therefore the bigger the risk of a problem later. And it seems to me that we are building up that problem for later. It's just a question of when is it going to hit?
Yeah, it's. I talked about the. I hope it wasn't with you. I hope it was someone else. But I talked about it looking like the Greek problem that occurred, around the GFC, where your currency is tied to the success of the German and French economy, and so your currency stays very strong. That means that to support your standard of living, you borrow, and the borrowing markets were very open and available, and that enabled the problem to be, the can to be kicked further down the road, and it was kicked further down the road for years. This is a bit similar because if we don't address the problem very soon, the problem will become almost beyond redemption in 5 years. Too much more property increase that outstrips incomes, and there'll be a bunch of people who, frankly, just can't afford housing, and who in the past might have. So it becomes tougher the longer it's left.
We end up with the definition of the Australian economy as the property market with a small economy bolted on the side, right?
Yeah, well, exactly. It's our debt, our government debt, is actually still small, even though it blew up through COVID spending measures. But it's still very small on international standards. But our housing debt, we're world champions. We're number 2 in the world. We were number 2. We might even be number 1 now. I can't remember who's number 1, but we might have taken over with this the strength of our property boom. It's been an international boom, though. It's been quite surprising. It's happening in other economies as well, and so house prices around the globe have gone up.
Yeah, I think Swiss might be number 1 still, but we're knocking on the door, and of course there are some weird things about the Swiss economy that may be masking what's really going on. But the point. And as we come to the end of this conversation, the debt pressure on households, the interest rate rises, individually people should be cautious and definitely be building those buffers. But strategically, we also need a different set of thinking to deal with this problem, because we actually are laying a bigger strategic problem for the Australian economy, aren't we?
Yeah, we are. The thing that's stopping it is the politics of it. There's no question. It's the politics. No government wants to go in to an election talking about this, and probably we'll see it at some stage in the future, because we have to see it. If there's a change in government in particular, I think we'll see it. But it won't be talked about pre-election. It's something that will just happen, and it's probably must happen. There's an inevitability, I think, that those measures that support investors will have to be reined in a bit.
Absolutely. Well, both sides of politics definitely singing from the same hymn sheet at the moment. Nobody wants to rock the boat. So, as you say, not much action this side of the election, although it would be quite interesting as part of the election campaign if people were actually starting to ask the politicians about what their strategies on housing were, and going beyond the supply side conversation, right? Because there is a broader strategic question here about the future of the economy, and if the property sector just gets bigger and bigger and bigger and pushes everything else out, that actually makes our economy sicker later, and it makes household balance sheets sicker later.
Yeah, that's right. I guess it's an interesting feature of an electorate that there are many more existing homeowners than there are prospective first home buyers.
Good point. Yeah,
they vastly outnumber it. And people love to think that their property has gone up by 20%, 30%. It's a nice feeling. You feel wealthier. You feel better about your finances in the future. And so it's not going to be popular to take a measure like that to the electorate, and people won't like it when it happens. But I just don't see any other answer to this.
Absolutely, the good old wealth effect, until it no longer has the effect that people want. Steve, really appreciate your time today. Thanks very much for your insights as always, and we'll keep chatting as we go through this year. I think it'll be a really interesting year. Yeah, I think it will be, Martin. Isn't it the old Chinese curse? I've heard it called the old Norwegian curse. May you live in interesting times, and we sure do. I think we certainly are there at the moment. Thanks, Steve. See you later. See you, Martin. Cheers. Cheers. Bye.